Gold is on an absolute tear, smashing records and surprising even the bulls. Today, we answer the big question: should you buy gold right now or wait? Stay to the end for our final take and a clear, practical path based on your goals. As of today, international gold has hit an all-time high of about $4,282 per ounce. In India, the local rate is around Rs 131,033 per 10 grams. Remember, international prices plus currency moves and local taxes drive what you actually pay. Making charges, GST, and purity all affect the final bill at your jeweler. So always compare quotes and purity certifications before you act, even during a rally. Driver 1. Geopolitical tensions. Gold is the go-to safe haven when uncertainty rises. Conflicts, elections, and sanctions increase risk premiums and push flows into hard assets. Institutions hedge tail risks with gold because it often decorrelates in stress events. Historically, volatility spikes have coincided with gold outperformance. When fear rises, liquidity seeks safety, and gold is liquid, recognized, and portable. Bottom line, geopolitics adds a persistent bid to gold, even if headlines come and go. Driver 2. Central bank buying. Sovereigns have been net buyers of gold for years. They diversify reserves away from currency risk and add a non-liability asset. Consistent official demand supports price floors and dampens sharp drawdowns. For them, gold is not a trade. It's strategic insurance. When the biggest balance sheets in the world keep buying, liquidity follows. It signals caution on fiat debasement risks, and markets listen. Driver 3. A softer US dollar makes dollar-priced gold cheaper for global buyers. Expectations of rate cuts lower real yields, which typically supports gold. When the opportunity cost of holding gold falls, demand rises. Lower yields reduce competition from fixed income for defensive capital. Macro funds rotate into gold as a rates and dollar hedge. Together, weaker dollar plus easier policy is a classic tailwind for the metal. Driver 4. Inflation. While noisy short-term, gold hedges long-run purchasing power. Over cycles, gold has preserved wealth through inflationary shocks. Households feel real-world inflation, and that fuels retail demand. Coins and bars become tangible stores of value during price spikes. If inflation expectations stay sticky, the hedge case remains intact. It's about resilience. Gold as an anchor against currency erosion. Driver 5. ETF inflows. Institutions scale exposure quickly through ETFs. Fresh inflows tighten supply and amplify momentum. Quant and CTA models often chase breakouts, adding fuel to rallies. More creations mean more physical demand from custodians. As liquidity deepens, participation broadens beyond gold bugs. If you're a jewelry buyer, focus on design, purity, and total cost. Making charges matter. Prefer hallmarked 22K or 24K with clear buyback policies. Compare making charges. A lower premium improves long-term value. For jewelry, utility is adornment plus tradition. Investment is secondary. If you're an investor, consider gold ETFs for market price exposure with low spreads. Sovereign gold bonds add 2.5% annual interest plus tax benefits on maturity. Physical bars coins give tactile ownership but carry higher premiums and storage needs. Typical diversified portfolios hold 5 to 15% gold, depending on risk tolerance. Use SIPs to average in over months. Avoid going all in after big spikes. Avoid leverage. Volatility cuts both ways, even in uptrends. Decide by goals, horizon, liquidity needs, and tax. Then pick jewelry, ETF, or SGB accordingly. Match the instrument to the purpose. Where? Wealth preservation or long-term compounding. Some experts now float targets near $5,000 per ounce if trends persist. That scenario assumes sustained central bank buying and lower real yields. Risks: faster disinflation, stronger dollar, or profit-taking by funds. Treat forecasts as ranges, not certainties. Position size accordingly. Prepare for both outcomes: extend, consolidate, or pull back. My simple framework: keep a core allocation, add-on dips, and avoid FOMO buys. Prefer SGBs for long-term tax efficiency, ETFs for liquidity, and minimal premium coins if you want physical size positions to sleep well at night. Gold is protection, not a gamble. Disclaimer: this is for educational purposes only and not financial advice. Consult a certified financial advisor before making investment decisions.